We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. Glad you are with us. You can always find out more about the team at Decker Retirement Planning just by going to the website. A lot of great information there. Workshops, seminars, all those things. There's some great information on the website as well. They certainly will walk you through the safer retirement process that they do with their clients, which really focuses on income planning and distribution planning. Today, we're going to talk about the markets a little bit and how the process goes with Brian and Brad and the team and how they help people with their portfolios, how to build them. And boy, you go back to, you think of some of the times the dot-com bubble bursting in 2000. You think back to the Great Recession, 07, 09. And a lot of people panic and just get out of the market. We know we cannot time the market. It's time in the market, so you have to have a strategy, and Brian and Brad are going to talk about that today on the program. But again, go to the website to learn more, DeckerRetirementPlanning.com, and of course, you can always call if you have questions. Boy, I wonder if my portfolio is set up the right way for me, because at the end of the day, Brian and Brad need to know your situation, what you want out of retirement, what are your plans, how are you going to spend your time before they can really come up with that plan. It's about you. How do they help? 833-707-3030 is the number. Complimentary, no cost to you. 833-707-3030. Welcome, Brian and Brad. And Brian, you think about it. August 2nd, markets drop. That's a Friday. Markets drop 600 points. Monday, August 5th, markets drop 1,000 points. Holy cow, we're going to have another great recession. And people tend to panic in those times. But my guess is your clients at Decker Retirement Planning, probably the phones weren't ringing off the hooks because you've already talked about this kind of the markets go up, they go down, they go sideways. Plus, we probably don't have 100% of our money in the market when we're getting ready to retire, do we?
When I was a stockbroker in the 80s, if you had volatility like that, the phones would be ringing off the hook. I didn't get any calls that day or either of those days because our clients know that they've got retirement planning principles, distribution planning principles in place, and want to go through what the difference is. But Brad, did you get any panic calls Friday or Monday?
No, I didn't. I think it was very volatile market, obviously, and it was nice to feel pretty confident that my clients didn't feel any need to panic. Those types of days, you are a little bit more on edge. You're wanting to make sure people know that they're comfortable. And yeah, the amount of times that the phone rings in a day like that can be an indicator of whether a client is maybe lying to you about their risk preferences. It could have been a lot worse. So no, it was pretty nice to get through that and then subsequent days and have people realize, oh, they're good. They're in good shape.
Let's differentiate between the two strategies. So when I was a broker, and banks and brokers are good, honest people. They work hard. They're honest, ethical, nice people for the most part. And they do a very good job in accumulation strategies. And these are buy and hold, pie chart strategies. In your 20s, 30s, 40s, and 50s, you should be accumulating assets. And that if the market drops 30, 40, 50%, your 401k is cut in half, no big deal, because you've got time on your side. You've got the 3 to 5 years for the markets to recover. Your income is coming from work. And every 2 weeks, you're putting money into your 401k that's down 50%. In the market recovery, at the end of the market recovery, you are better off for just sticking to your plan and riding it out. However, let's switch it. Now that you're 65 or older, you're retired, your portfolio is providing you income during your golden years, and now it drops 40 or 50%. Your income's not coming from work, it's coming from your portfolio, and you draw income from a portfolio that's down 40 or 50%, and that is terminal. That is lethal. Mathematically, when you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down, and many times that sends you to a plan B retirement where you got to sell your home, move in with the kids, go back to work, something. We don't want that for our clients. So in contrast, we have distribution strategies. Distribution strategies differ from accumulation strategies in 6 key ways. And we're going to talk about one of those ways here for the rest of the program. But here's the 6. And if you're driving, this is worth going and pulling up the podcast. And that podcast is Safer Retirement is how you'd pull that up. But here's the 6 key parts to any retirement portfolio, in our opinion. Number 1 is to have a plan. Most people don't have a plan, and they're told by their banker and broker that a pie chart is a plan, and a pie chart is not a retirement plan. There's no income planning from that. And I think that's the reason why the number 1 fear in the United States is running out of money before you die, because no person can look at a pie chart and see how much money they can draw. They're totally guessing, and they know that. And their distribution strategy is the 4% rule. And the 4% rule is, again, drawing income. As long as the market's going up, that works fine. But when you go into a flat market cycle like 2000, there's been 4 times that there's been a flat market cycle. 1929, markets were flat for 17 years. 1964, markets were flat for 18 years. November of 1999, markets were flat for 14 years. So you go into a flat market cycle and you use the 4% rule, you will go back to work. You will destroy your retirement plan. You cannot draw income from a fluctuating account like 2000, 01, and 02. S&P is down 50%, NAS is down 70, and you're drawing 4, 4, and 4. Markets come back 100% by November of 2007, and then they drop 50% again to March of 09, and you're drawing 4% from that. And that's why we saw millions of gray-haired people come back to work in 2009, because the 4% destroyed their plan. And so we, in the point 1 of this 6 key points of a retirement plan, point 1 is to have a plan. We use a distribution plan, which we're going to talk about in detail in a second. As a matter of fact, Brad, do you want to mathematically describe for our radio listeners a distribution plan in 90 seconds? Can you do that?
Yeah, a distribution plan is where you're systematically setting up certain pieces of your portfolio, your total number, the amount that you have to be able to draw from. We call it your investable assets or liquid assets. And it's where you're tying very specific investment horizons to when you plan on withdrawing the funds that you need to live on from your portfolio. So when you're planning out systematic withdrawals, those distributions become the driver of one of the sources of income that you can rely on throughout your retirement. And so we pair that up with other sources of income like rentals and business income or pensions, Social Security. And when you add all of that up, you get to a predictable sort of way to be able to draw money from a portfolio over a lifetime.
And you've got the different spigots of money. You've got Social Security income, you've got pension income, you've got rental real estate, you've got portfolio income. We totaled them all up minus taxes. That gives annual and monthly income with a COLA, cost of living adjustment, that goes up each year to age 100. So people can do income planning if they want to dial it back and stay under certain levels of income to qualify for certain programs. They can do that. If they're just nudging up against a tax bracket like 32% and they want to stay under that, they can do that. We can do income planning on a distribution plan. You can't do that with a pie chart. We can do tax planning with a distribution plan that you can't do on a pie chart. So first thing is to have a plan. Most people don't have a plan. At Decker Retirement, we put out a math-based distribution plan. Second is comprehensive tax minimization planning. And so this incorporates many things, and we are big proponents of the Roth conversion strategy. But being math-based, we know to the dollar how much of the portfolio we should convert to Roth, which most people don't. And number 2, where the Roth money should go. And most people don't have a clue. So there's a right way to do Roth conversions, and we want to make sure our clients take full advantage of that. I think that's going to be the biggest tax saving strategy that most people have in their lifetime. We also have placement of where to put qualified money as opposed to non-qualified money. That's very, very important in saving you taxes. We talk about donor advised fund, charitable remainder trust, qualified domestic relations orders, irrevocable life insurance trusts, the net unrealized appreciation, dynasty trust, cost segregation. All of those things are just kind of the tip of the iceberg. We get very detailed when it comes to tax minimization strategies. Those are very, very important. Third is risk reduction. We're going to spend a lot of time on that today. Risk reduction, there's 3 parts to it. One is completely eliminating interest rate risk. Why would you own bond funds when interest rates are going up? That is categorically silly, ridiculous, and against professional. If you've got a broker that's telling you to buy or keep your bond funds when the 10-year treasury hit 0.47 in August of 2020, I just think that's incompetence. So from 1940 to 1980, there was 40 years where the 10-year treasury went from 2% up to 15%. And then from 1980 down to 2020, 40 years of declining interest rates, from 15% down to 0.47. Well, now we have a rising interest rate environment, and there's 35 trillion reasons why interest rates may go higher. The Fed may cut their rate. They have a managed rate, but the open market rate may go higher because we have 35 trillion in treasuries that we have to place every quarter. So want to point out that we eliminate any bond fund exposure for our clients so they have no interest rate risk where you lose money on your bond funds when interest rates go up. The average person has lost over 30% in principal in the last 4 years on their bond funds. So we eliminate that. Second, we quantitatively shrink their risk. In retirement, any banker or broker that says you should have a 60-40, 70-30 portfolio, we think that's insane. We have our clients quantitatively lowering their risk down to about 25% of their portfolio. And then strategically, we lower their risk by having different strategies out there aimed at protecting their capital in a down market. We have a 2-sided strategy that's designed to make money in up markets and down markets. We're going to talk in detail about that today. But number 3 is lowering clients' risk, lowering their risk exposure. Number 4 is optimizing every part of your portfolio. We, on a monthly basis, look at the Wink database that lets us see the highest earning principal guaranteed account offerings from banks and insurance companies. And we pride ourselves on optimizing every part of the principal guaranteed side and the risk side. On a quarterly basis, we go to the biggest databases available. We look at 5 of them, and we mathematically look at what is producing the highest, most consistent returns for our clients, and we plug those in. Number 5 is income optimization. By default, if we are minimizing your taxes, minimizing your risk, and maximizing or optimizing your portfolio, by default, we are optimizing your net monthly after-tax income. And the last one are fees. When it comes to fees, number 6, most people in the United States pay 1% in management fees. Our clients pay typically and on average about 70% less in fees for our clients because we don't charge a management fee for the laddered principal guaranteed accounts that we have in place.
So again, if you'd like to sit down with Brian, Brad, and the team at Decker Retirement, you certainly can do so. You've got questions. You're kind of like, boy, I don't think my portfolio is set up the way Brian is talking about it. I would like to learn more. There's no cost to do so. I don't know why you would not take advantage of this. It's 833-707-3030, totally complimentary, 833-707-3030. It's an opportunity for you to get some clarity into your retirement picture. 833-707-3030. We're talking about risk in your portfolio. And certainly at Decker Retirement, they typically are looking at 75% of your portfolio is safe and protected. 25% is in the markets. So they're going to talk more about how they set all this up, what it means to you. Certainly it would ease the stress level when we have a market downturn. But again, that's 833-707-3030. More Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 3030 to start your legacy journey.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Again, you can always go to the website DeckerRetirementPlanning.com to learn more. You can also go to that website, DeckerRetirementPlanning.com. Under the heading of Safer Retirement Education, there are like 12 different things you can download, and they're really all there for your information, for you to learn more about retirement and different areas that you'd like to learn more about. There's 12 different things to download. Download one, download all 12. Your choice. And part of that is Brian's book on retirement, the Decker Approach book. That is one of those things you could download. And Brian will walk you through retirement and kind of how things work at Decker Retirement. It's a great opportunity for you to learn more. Again, that's under the heading of Safer Retirement Education on the website, DeckerRetirementPlanning.com. I'm Mark Elliott, Brian J. Decker of Decker Retirement Planning, joined by Brad Geddes of this team as well. And you guys are talking about risk strategies today, pros and cons. And you're talking about typically, Brian, your clients typically have about 25% of their money at risk, which means 75% of their money is not at risk. Can you guys talk more about that?
Yes. Let's go through the different options that we offer clients, Brad. And I'll tell you what, let's have you be the pro and I will be the con. What the positives and negatives we want to make sure as fiduciaries, we want to flesh out. There's positives and negatives to every strategy. So Brad, on buy and hold, dividend, sector rotation, I think sector rotation and two-sided are the same. But Brad, you take the pro on buy and hold, dividend, and some of the other strategies that we offer. I'll take the pro on the two-sided strategies, and let's go back and forth on those. How's that? So Brad, why would you recommend a buy and hold strategy? Let's talk about the benefits there.
Yeah, so there's 4 main advantages, I think, and I got a few disadvantages of the buy and hold. First off, to make sure everyone understands, this is the asset allocation approach. It's probably the most popular, and by popular, let's just say it's the most used, because it's kind of the classic way to pair stocks and bonds to create risk-weighted returns, and the more stocks you have, the more aggressive you are. I think the primary advantage of this approach is that it's simple and requires minimal maintenance. And because of that, I think for DIYers, where they just look like they just want to do it on their own.
What's a DIY?
DIYer, do-it-yourselfer, someone who's going to do it on their own, not look for professional advice, kind of trust their ability to navigate markets on their own. The buy and hold approach is the least maintenance, and it's the one that'll, there's some drawbacks we'll talk about, but it is more doable for someone that's going to be managing their portfolio on their own. And frankly, it is so simple that I always find it baffling when people pay for it. When people pay an advisor to just maintain a 60-40 blend or an 80-20 blend, because that's the type of level of effort that I think someone could be able to do with a couple of hours of work over a quarter or a year even. Another advantage of this approach is that I like to say it's the most long-term predictable. It actually forces people to have a long-term view on their portfolio, because the short-term is extremely unpredictable. But over the long run, the risk-weighted returns, the overall risk that's incurred for the level of gains that someone's going to maintain, it's predictable in a way over the long run, but certainly loses all predictability in the near term. The last two kind of similar, but on the they're kind of two sides of the same coin. There, the compounding effect of the buy and hold approach is quite attractive when you're just leaving it in there and you're letting it grow and it's building and growing. The compounding is nice, and then because you're holding the same assets that are working together to build a portfolio. But on the flip side of that, it does also produce some tax efficiency, because when you're not turning over your portfolio, this is especially for any of your taxable assets, the assets that are not in your retirement account. This can be a tax efficient way to grow a portfolio and even harvest, because you're only paying capital gains rates on those. So, some advantages to think about. I think I would err more on the side of just it's simple, and for someone that was going to manage their own assets. When we get to some of the more advanced strategies in a little bit, you'll see it starts to get kind of unwieldy unless someone really knows what they're doing on their own.
And Brad, there's advantages and disadvantages of all these different strategies. So the disadvantage, I would say, of a buy and hold strategy are a couple of things. One is, in the last 100 years, there's been 4 times that the S&P 500 is traded above a market valuation of 30 times trailing earnings. One was 1929, and markets traded flat for 17 years. The second, 1964, markets traded flat for 18 years. The third, November of 1999, markets traded flat for 14 years. The fourth was November of 2021. We hit 32 times trailing earnings. And if history repeats with 100% history backing it, we're looking at 10 to 15 years at least of flat markets. That means that buying and holding any passive investment strategy, buying and holding stocks, mutual funds, indexes, or ETFs will yield a zero return. So that is one of the reasons why we're going to talk more in detail about the benefits of a two-sided strategy. Now, there's advantages and disadvantages of a two-sided strategy that we'll talk about. But number one, the one drawback that I feel is very important of the two, one is that we believe that we've entered a flat market cycle. Second is time, T-I-M-E. If we have a downturn like 2001 and 02, and we've entered a flat market cycle, and it takes 10 to 15 years to have markets come back, you're drawing income from these portfolios that are flat for 10 to 15 years, and that's devastating to clients. So their income, they don't have the time to have these markets recover because they're drawing income from them, and their income is coming from the portfolio that's down or flat for a long period of time. So those are the couple of negatives that I would throw out for the buy and hold strategy. Another one, Brad, I think is a positive is in a correlated strategy, buy and hold, markets go up, you get what the market gives you. Markets go down, you know that your portfolio is down. So there's no frustration that the market is up and you're not up as much. Would you agree?
Yeah, it's you and all your friends, or you and the rest of the market. Everyone's kind of performing in line with one another. And so, yeah, there is a little bit of that groupthink benefit of everyone losing money together in a way. And I think there's a couple others in that I like to add is that, obviously when you're pairing asset classes, the goal is to not just simply tie yourself to the stock market and a 10, 12-year break even. But at the same time, I do think that some people think that they can draw a more stable level of income from their portfolio than I think would be tolerable. So, you hear about that classic 4% rule, and that's supposed to be your sustainable withdrawal rate mathematically over a 30-year period of time with a 60-40 portfolio, which is 60% stock, 40% bonds. But the reality is when you do go through those downturns and when you do experience the losses that happen every so often with the more buy and hold approach where you're maintaining a blend, targeted blend, I think a lot of people do end up varying their income that they draw out. And even if math supports supposedly the ability for them to draw the same amount because fingers crossed things rebound strongly like they did after 2008 for 14 years of a bull market, I do think people tighten that belt a little bit. And it makes for, at the very least, not a very pleasurable retirement to look at a portfolio that, say, had $1 million in it and you're drawing $40,000 out. And now you're drawing $40,000 out from a $400,000 portfolio. That's a 10% withdrawal. I'll bet most people maybe held back a bit. Maybe they drew $20,000 that year or $10,000 that year. and possibly even consider dusting off their resume. So one primary disadvantage of the buy and hold approach to me is that people need to expect that their income is going to vary. I think there's a not very stable estimate of that 4% rule that a lot of people go into retirement expecting to be able to drop 4% of their portfolio every single year. But the reality is when markets do go through their inevitable volatility, I think people will learn that they need to adjust their income expectations in order to ride through any inevitable downturns that we're going to encounter. So I think income variability is one of the biggest disadvantages to me of the buy and hold approach.
So again, if you'd like to sit down with the team at Decker Retirement Planning and go, boy, I haven't really thought about this as in depth as Brian and Brad have. I'd like to learn more about how this really affects our situation or my situation. 833-707-3030 again is the number. There is no cost whatsoever to you. Brian, Brad, and the team at Decker Retirement do not know if they can help you until you reach out. Maybe you don't even need their help. They will tell you that. Maybe they can't help you. They will tell you that. Maybe they can help. They will tell you that. And then it's, do you want their help? It's really pretty simple. 833-707-3030. Again, no cost for this chat. There's no pressure, no obligation, no judgment whatsoever. Boy, I don't know if I've got enough to sit down with the team. I don't know. Maybe they'll look at me badly for what I did. I'm still holding on to Blockbuster stock. It's going to come back. There's no judgment. Brian and Brad and the team are here to help. 833-707-3030. 833-707-3030. Brian and Brad are going to come back, talk a little bit more about the pros and cons of risk strategies. Going to get into the dividend world a little bit when we come back on Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Back right after this.
Do you need help assessing your risk tolerance or adjusting your portfolio to help reduce your fees? For help with income planning, set up an appointment with Brian Decker today. Call 833-707-3030. That's 833-707-3030.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Again, you can learn more on the website, deckerretirementplanning.com. Under the heading of Safer Retirement Education, you can download 12 different things, including the 3 Principles of Retirement book, Brian's book on retirement, the Decker Approach book, the Checklist Challenge, Sample Income Plan. There's a lot of information there for you. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. Download any or all that you'd like to know more about. 833-707-3030. If you're just like, man, I'd really like to know where we are. Can we retire? Are we going to be okay? I would like to at least know that. Get some clarity into your retirement picture. It's an opportunity for you to do just that just by picking up the phone and calling the team. 833-707-3030. So Brian and Brad are talking today about how to build a retirement portfolio to weather market downturns, yet still be able to grow your assets. And Brian, I think you're heading into the dividend world in this segment.
Yeah, we'll talk about the dividend strategy. You want to make sure that people that just jumped on for the segment get context. We're talking about the risk portion of our clients' distribution planning portfolio. And for us, we ladder principal guaranteed accounts for about 75% of the portfolio. We have liquid cash for one bucket. We have a 3-year and 5-year fixed rate bucket. We have 7 and 10-year principal guaranteed accounts. All of those account for the first 15, 20 years of income for clients. And then we have the risk bucket, which is about 25% of the portfolio, growing for that 15, 20 years to fully replace what they've spent in that 15, 20-year period. So it's beautiful how the distribution plan works. It gives that runway to have that account grow. Now, on the risk strategy in the last segment, Brad did a great job of talking about the benefits of a targeted risk portfolio, which is correlated to the different market indexes, also called buy and hold. I mentioned some of the negatives that are associated with that. Brad, let's do the same thing with the dividend strategy. I think the dividend strategy is easily one of the most popular strategies in retirement. So what are the benefits of the dividend strategy? And I'll take what are the drawbacks of the dividend strategy.
Yeah, I think the primary advantage people are seeking when they have dividends is just regular income. These dividend-paying stocks typically have a long history of paying a certain amount of their earnings or a certain dollar amount that people grow to rely on, sometimes after many decades of holding the stock, and they find that reliable source of income to be comforting. And that becomes what they use as kind of an anchor in their retirement income. Now, the thing that's good about that regular income is that it is cash. It's cash received. And so while there's a lot of total return type investors where they say it's not about cash versus the growth of a stock, it's about the biggest portfolio possible, that would disagree with this, there actually is something nice about having cash added to an account, because otherwise you'd have to hypothetically sell off shares in order to generate the same cash. And while, again, some total return style investors would say, why would you do dividends when they could reinvest that in the growth of the company more efficiently and have more money there for you to draw? I just know from years of doing this that having cash deposited in the account is quite an advantage over having to sell stock to raise cash to spend. I think the two other sides are when it comes to the growth of dividend strategies, they do tend to be more stable portfolio holdings. So they are obviously generating cash flow and distributing that to their shareholders, which means the companies are usually pretty well established, been around a long time, pretty well-honed machine for producing profit and passing that on to shareholders. So that kind of established types of company does tend to be larger, bit more dependable for that future growth and being there in the future, I guess, as opposed to like a tech company that might be making a ton of money now, but maybe could get cut out of its market with the next innovator. I think the last part, and this is the thing that I like, if a client does use this, especially with some of our more income-focused growth strategies in the risk bucket, is that the reinvestment of dividends are a really handy way to be able to grow more. You're basically buying more of something that is going to pay you in the future. And it can be a good way to reallocate and accumulate. It's why in a dividend portfolio for us, we're not using it for the regular distributions because of the disadvantages we're going to get into. Things like you're in concentrated risk, you retain a ton of market risk, they can cut dividends. But that said, if someone is looking at a long-term holding for diversified set of companies and they're drawing those dividends and reinvesting them, it can be a good way to accumulate a portfolio, assuming markets behave.
All right, good. So now I'm going to talk about the negatives of the dividend strategy. And I think that they really focus on just three negatives that we want to point out as fiduciaries to our clients. One is that human nature gets involved with the dividend strategy. So right now, Brad, let's have you be the typical client. I say to you, the 10-year treasury right now is around 3.9. If you can get a 5% dividend, 5 is better than 3.9, right?
Yeah, keep going. I think I know where you're going with this.
Okay. And Kiplinger puts out a great dividend strategy full of 7 and 8 and 9%ers. Those are better than 5, right?
Sure.
Okay. So human nature has what we call dividend yield creep. And people think in their minds, very smart people, that they're having less risk owning a dividend portfolio, and yet they have a yield creep tendency to where inside of 18 months, 2 years of putting their dividend portfolio together, most of their portfolio is in these 8, 9+% yield dividend stocks. Well, then they come to the office and I ask, hey, Mike, or in this case, Brad, hey, Brad, what is your favorite dividend stock? And you'll point to the 9%er. Yep, that one right there, XYZ Corp, 9%, looky right there. So I pull up the financials on that stock and turns out that sure enough, they're paying $1 dividend. That's a 9% yield. But then we go to EBITDA, earnings before interest, dividends, taxes, and amortization, and we find out that the company's earning only 60 cents of that dollar dividend. And this is when the blood drains from their face because they never realized that they had a high-risk portfolio and that the stock, and I asked them, I said, how long are they going to borrow to pay the dividend? And have you ever been through a dividend cut? And this is when they just are unresponsive. And I say, let me tell you how it goes. After the market closes, they announce a dividend cut or a dividend elimination, and the stock drops 30%. You'll have to sell it out of your portfolio because it no longer pays a dividend, and that's how it works. But wait, there's more. So that's the first problem on the dividend portfolio. And those that do want to put a dividend portfolio together, just make sure the coverage of that dividend, EBITDA, is at least 150%, at least 150%. So do some checking and make sure that your dividend portfolio is covering the dividend by 150%. The second problem has to do with concentration. Concentration means that most of the higher dividend stocks are in two sectors of the market, energy and real estate. Does energy cycle? Yes. In 2020, when COVID hit, we had something happen that I've never seen in my 39 years in the business, and that's a futures contract go negative. The August crude oil futures contract went negative. I've never seen that before. That year, 2020, oil stocks hit lows, oil prices hit lows, and across the board dividend cuts in the oil patch happened. You can't do that in retirement. You can't take these kinds of hits. The second is real estate. Does real estate cycle? Absolutely, every 15 years. So we are due a hit in real estate. And by the way, one is brewing with commercial real estate, but every 15 years or so, real estate cycles. Last one was the housing crisis of 2008. The average REIT, real estate investment trust, in 2008 was down over 70%. And there were across the board dividend cuts in real estate. So in retirement, you cannot afford to take that kind of a hit. And sadly, in retirement, you cannot afford to buy a very strong dividend stock like 3% and take 10 years for every year for them to have the gains to get that yield up to where it's competitive. So that's problem number two. Problem number one is the human nature of yield creep, pushing you into high risk investments. And I don't blame people. I blame Kiplinger, knows better to put those portfolios out. The second is yield coverage and concentration. The third has to do with where we are in the interest rate cycle. Interest rates are going up. Dividend stocks lose value when interest rates go higher, period. That is a math-based principle. Just like mutual funds lose value, dividend stocks lose value when interest rates go higher. So those are the three problems that we have. And when it comes to risk portfolio, a dividend portion of the portfolio may be under consideration, but to have your entire portfolio be in dividend stocks, I think is a mistake. Brad, anything else on the dividend portfolio before we spend probably the rest of the radio show on two-sided strategies, the momentum strategies that we use?
Yeah, I think just two more. I think one of them you touched on. I think I just maybe phrase it a little differently. It's just those dividend cuts. You know, it's a real thing that they can cut dividends. It's an optional distribution that they can do. They've done it historically. A company, hypothetically, they've done it historically, but they don't have to. It's not like a bond issue where they have to pay that to you. So prepping for what you would do in the event of dividend cut because of leaner times or something, or a critique of how the management is using their cash flow and can't find anything better to invest in than giving it away. Dividend cuts are very real. The last one, I think it also just leads to, from a risk standpoint, if people really do want to own cash flowing companies, it does put them into a very concentrated position in the broad equity market, things like utilities and consumer staples. They're going to own a lot of those companies, which is going to have a disadvantage of you're not owning the broad market. So those might do well in certain environments, but they can perform poorly in other environments. It limits the ability to diversify if people are just seeking cash flow as a primary metric for buying a stock or owning a stock.
So again, if you would like to talk with the team at Decker Retirement, learn more about what they're talking about, how it pertains to you. We talked earlier about, Brian and Brad talked about having maybe only 25% of your money is at risk, 75% is safe. Well, that might not be the right numbers for you. That's just generally speaking. But the idea is that all of your money is not set in the market when you retire. And if you go down 40%, that's a big hit if it's all your money. So if you have questions about that, how does that pertain to your situation? Just give them a call. There is absolutely no cost to do so. It's a great opportunity, I think, to get some clarity into your retirement picture. 833-707-3030, again, is the number. No cost to you, totally complimentary. 833-707-3030. It's an opportunity. It might be the most important phone call you make, and you haven't even made it yet. Why not? 833-707-3030. Brian and Brad are going to get into the two-sided strategies, if you will. That's next, right here on Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Back with our final segment right after this.
Maximizing your deductions is like finding hidden treasures in the tax code. Let's navigate the financial landscape together. Call Brian Decker at 833-707-3030 for guidance.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. 833-707-3030. If you have questions, you have concerns, you're not really sure what's going on in the market world, I'm not really sure I'm set up the right way for our situation as we head into retirement. Want to make sure we don't run out of money before we run out of life. Can we retire? When can we retire? Are we going to be okay? That's really what we want to know. 833-707-3030. All right, Brian, last segment for you and Brad, and you're going to get into the two-sided strategies, correct?
Yes. So we did our homework when we put the risk strategies together, and we offered momentum strategies because the biggest study ever done since 1950 on what has produced the highest returns in up markets is in a book, What Works on Wall Street, page 367, Appendix A. Jake O'Shaughnessy talks about what has produced the highest returns. Not the top 1, 2, or 3, but the top 10 to 15 are all absolute return, momentum, relative strength, sector rotation strategies. Categorically, it's the same. So listeners, listen to the description of how this works, because these strategies have produced superlative intended, the highest returns since 1950. Every stock is assigned a relative strength score 0 to 100, and you own in your portfolio the top relative strength stocks. For example, in the strategies we use, 2 of the 5 strategies we use, one of the 2, you own the top 7 stocks based on relative strength in the S&P 500. The second strategy is you own the top 5 stocks in the NASDAQ 100. And so those are 2 of the 5 strategies. I'll continue on how we use momentum. The third strategy, you own the top 3 sectors of the U.S. market. Number 4, you own either the S&P, the NASDAQ, or the small cap index, or cash, but you buy and you own the top performing index that's going up. And then the last one, you are either S&P, TLT, which is the long-term treasury, or you're in cash. And those strategies are pure momentum and relative strength based, period. So let me tell you how this works. In 2000, 01, and 02, when the S&P was down 50%, NASDAQ was down 70%, momentum has you buying the top any stocks that are going up. And there were many. Real estate, the REITs were going up all 3 years during that debacle. Gold and silver were going up. Energy, pharmaceutical, biotech, healthcare, all those stocks made double digits all 3 years. You would have owned those stocks and sectors using the momentum strategies. Then markets bottomed in March of 03, and what exploded to the upside for 4.5 years were the following: small caps, emerging markets, technology, and semiconductors. When I say exploded, I mean triple digits. They exploded to the upside. Then markets rolled into 2008, and the momentum is absolute return focus. So if nothing is going up, you are stopped into cash. It has to be going up. And so you're stopped into cash into 2008 with one exception, and that's treasury bonds that were up 20% in 2008. That's how these work. So we even went further. We use momentum strategies for our clients in the risk bucket because when markets are going higher, we are cherry picking the top parts of the market and investing in those, in individual stocks and in sectors. But when the stocks drop to a downtrend where the S&P crosses the 200-day moving average, which is the definition of a downtrend, that is when we, just like in the NFL, there's an offense and a defense. When the S&P crosses from an uptrend to a downtrend, we take the offensive team off the field, we put the defensive team on the field. Those are hand-picked momentum strategies that do very well in down markets. In 2022, for example, 2022, the S&P is down 19, NAS is down 33, bonds were down 20, commodities across the board were down, but these momentum strategies that we're using on defense focused on what was going up that year, and it was one sector, and that was energy. The crude oil companies, natural gas companies, the frackers, the drillers, the pipelines were up 15 to 20% when most people lost 30. So we have a two-sided strategy. We use momentum. We've done our homework. Those are the advantages. And by the way, if we, early in the radio show, we talked about how there's been 4 times that the S&P 500 ever in the last 100 years has traded above a market valuation of 30 times trailing earnings. It's only happened 4 times. One was 1929, the S&P was flat for 17 years. Second was 1964, markets were flat for 18 years. Third, November of 1999, markets were flat for 14 years. The fourth happened in November of 2021. We hit 32 times trailing earnings. If history repeats, and by the way, with 100% history behind us, we are fully expecting at least 10 to 15 years of flat equity markets. 2 steps forward, 2 steps back for 10 to 15 years. Now, that's devastating for someone in retirement. With the strategies we put together, having an offense and a defense, we expect to do well for our clients in up markets and down markets. But there's some disadvantages. So Brad, let me toss it to you.
Yeah, I think the main one is this is a very complex strategy, right? I mean, there's a reason that clients will rely on firms like us to be able to deploy this because you have to have the right team in place to be able to manage it. You have to be able to afford the research that we pay for to be able to find the best models that are out there. I think so that's kind of a tough one is it's hard to scale with just a single individual versus a large RIA like us. I think the next disadvantage of this approach, it gets to the non-correlated aspect of the return profile. So when you're looking to generate your own returns from the market, not meaning put the other way, most advisors are having the market generate the returns for them. When you're using an actively managed strategy like identifying sectors that are attractive in a particular period of time or identifying certain momentum profiles or relative strength that looks attractive based on historical data. you do start to decouple your returns. And to be fair, it's intentional because when you're decoupling your returns, you do have the potential for higher yields, potential for higher rates of return or above average returns. And that comes also with potential for, as you said, Brian, to be able to mitigate losses in the downtrends, right? If you're actively looking to generate your own returns with a portfolio strategy, well, you don't necessarily just need to ride your way through a big market downturn. It's one of the hardest parts about buy and hold is that you have to ride it out in order for the math to be true for the predictable yields over the long run. So the non-correlation can be tricky because in especially very greedy exponential bull markets, it can be tough to watch the buy and hold strategy do really well. And in those instances, what a lot of people will do is they'll jump right into markets when they're hitting peak valuations, just as they're about to turn the other way around. And so with a non-correlated strategy, you look to generate those higher yields over time and anticipate that there's going to be the need to be able to mitigate some of those losses with the lower returns or lower correlation that comes in the down market. So non-correlated yields is probably one of the hardest things about the return profile of a two-sided model.
Now, Brad, I just want to add, you brought up a great point. Since January 1 of 2007, S&P's averaged around 9%. These managers have averaged 18%. But that's because they're cherry picking the best parts of the market. But there are years between when these managers started, January 1 of 2007, there's many years in there where they didn't beat the S&P, but there's many years that they did by quite a bit, and they didn't take those hits in the market. So the two-sided strategies were able to make money in all the down markets since January 1 of 2007. That means 2008, 2015, 2018, and 2022. So the downside is protected and have done very well. But again, these are not guaranteed strategies. These are risk strategies. And the upside, we're cherry picking the best parts of the market. When it comes to fees, though, I just want to emphasize, you mentioned costs. Fees still, this is something where we only charge on the risk portion of the portfolio, which is typically around 25% of their portfolio. And that equals about 0.3, a 70% savings over what the average person is charged, which is about 1% per year on their entire assets. So we're happy about that. I just had one thing I wanted to say, which is during transition periods when the offense is changing to defense, there can be drawdown, but that only takes me 20 seconds to say. One other thing on the two-sided strategy is during transition periods where we are transitioning in the market from offense to defense, or there's a rolling sector rotation, like for example, earlier in the year, smaller banks started a very strong trend because interest rate expectations were to drop and banks are interest sensitive. So the banks came on as a sector that we invest in. We never invested in individual banks, but the sector came on board, and then it came off about 3 weeks later, and we took a loss on that trade because there was no follow through. That's called whipsaw. There could be whipsaw in this that causes drawdown. Drawdown is when it draws on the portfolio. But other than that, when there's a trending market, these strategies on the momentum side are very, very good. Brad, do you want to wrap us up?
Yeah, I think in conclusion, we're talking about what ends up being maybe a quarter of someone's total retirement portfolio. It's meant to be their longest term holdings. And so especially in our offices, we're talking to our clients about how do they want to invest the money that they need to come back to maybe in 15 or 20 or years, or maybe never. Maybe it's invested for kids or grandkids. So that's intended to make sure that people are viewing these holdings with a long investment horizon. I think the buy and hold approach is really good for people that are doing it on their own. You know, they're not looking for anything fancy, not looking for excess market returns, and they have an iron stomach to be able to ride through the downturns, the market volatility that comes with it. Very little involvement there. I think the stock dividend approach, it works well for people that really value the cash flow as a portion of their accumulation. And if they're tolerant of some concentrated market risk as they hold a small sliver of the market, focuses on cash flow, that can work well, as I think mainly if they do maintain that long investment horizon. And then with two-sided or active management, that works well when people are concerned about how they would do in a downturn, and they might also be looking for the potential to have excess market returns or alpha, sector rotation, momentum, relative strength. Two-sided model side is really the only place you're going to find that, because it does require active management for that to work well in a client's portfolio.
So again, if you'd like to talk with the team at Decker Retirement, how does this all pertain to you? How is your portfolio set up? Markets get a little wonky. Are you comfortable with that, or would you like to have a little bit more clarity into your picture? All you have to do is pick up the phone, give them a call. There is no cost for this. 833-707-3030, 833-707-3030. Great opportunity to get clarity into your retirement picture. No cost to you. 833-707-3030. Brian and Brad, always enjoy it. Thank you for being with us for Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Have a great weekend. We'll be back with more next weekend. Thanks for being with us.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.